Good day to one and all. This is Dr. Sivaraman of IKnowIndices.com. Tracking the forex market together, part 1, between 9 and 9:45 GMT. So we will be tracking the market from now for another 45 minutes, and we will use the live market quote page as a tracking tool. I'll give the link for the same. I'll also focus the camera over that of the live market quote page. Currently, you can see that euro is trading around 1.3273, 1.3273, 1.3265 is the low, 1.3352 is the high, 79 pips negative net change is seen. So you might have seen in the blog that I have given that there is going to be an early European session drop followed by a quick rise in the case of euro and GBP today for the weekend, and so the drop there commences, and once they stop cutting the low for about 10 to 30 minutes, we can try to take the buy positions during this. This is an downward stop and before making further rise, and they show the new levels so that the traders become panic and try to cut the positions or stop out, then later on they buy and gain the levels. So this is what you come across on a daily basis on the downside and the upside. GBP is trading around 1.5463, 1.5464, 1.5447 is the low, 1.5499 is the high, 33 pips negative net change is seen. When euro has dropped more, about 80 pips, GBP has dropped only about 33 pips because it has made the drop from yesterday from 1.55 to 1.54 area and made a breach below that of 1.5450, the psychological level, and started gaining the levels. And in the case of yen, it is trading slightly above, and 77.44, 77.44 you come across some strange thing. Bid and the ask are the same. 77.11 is the low, 77.54 is the high, 33 pips negative net change, positive net change is seen. So you come across that USD gaining moves are shown in the majors. CHF is also trading around 92.57, 92.58, 91.92 is the low, 92.60 is the high, 60 pips positive net change is seen. And in the case of USD CAD, it is trading closer to that of the psychological level, 1.05 area, 1.0496, 1.0497 of the current levels, but the spread is only about 33 pips. 1.0464 is the low, 1.0497 is the high, 26 pips positive net change is seen. Australian dollar is trading around 96.82, 96.88, 96.67, 78 is the low, 97.36 is the high, about 52 pips negative net change is seen. All the currencies are showing to start with for the weekend here, USD gaining more, and they are expected to make just a reverse from here, and that we will track it and try to take the positions and see how exactly they are handling the market during the day. So in this tracking the forex market together, we need to know first of all the timings to be followed, and these are all the timings followed by that of the players. And once the daylight saving system is off, these are all the following timings. Now we are currently watching the European session. 0800 to 14 GMT is the European session. So 7:30 to 8 is the gap time before the start of the European session. And during the gap times, they make the false move, and they firmed up a little bit during the gap time and then started making the slide now in order to continue this lower level swing for another 30 minutes and start gaining the levels during the day. And let us review it during our discussions and try to understand how exactly we can take trading decisions. So we track the market using the GMT timings so that it will be easy to track the 24 hours market. It is a continuous market from Monday to Friday. So on a daily basis, we have to track the market using the GMT time, and I explained it, the GMT time frames for the 3 sessions in the earlier slide. So if you could follow it using the live market quote page, there the GMT time is also in display. It is easy for you to track the market following the session timings and the gap time. So always you come across a gap time before the start of the session, before the banks officially open for the day. They have the gap time of 30 minutes, and during that the players try to use specific type of orders and trigger the stops either on the upside or on the downside. And then you come across the session start time. It will be 1 hour and 30 minutes from that of the session start. European session starts by 8 GMT. So up to 9:30 GMT, you will come across the early session. They will be handling the majors. Now you can see that they have handled the major by making a quick dump in the case of euro for about 50 pips. And from that of 1.33, they came down to that level of 1.333275 and then made a downward stop and below that psychological level 1.3275 to that level of 1.3265. And this they try to do it because the traders keep the stops below that of the supports, and then they try to hit the stops during such times either on the upside or on the downside. Now if they don't cut the low for another 10 minutes, they cut the low by 1 pip. Now 3264 has become the low. So we will watch for another 10 minutes and then try to take a trading decisions now. It might appear that we are trying to trade against that of the trend. It is not like that. The players cannot bring euro to zero. They have to make a downward stop and afterwards breaching all the psychological level and try to find the cluster of stops there and try to hit it in the name of the Greece sentiments or European negative sentiments, etc. Then subsequently on a daily basis they have been making up and down moves. So you should not be carried away with that of the sentiments created in the market, and they are all the sentiments they need in order to induce the traders to do distressed trades. Subsequently they try to change the sentiment by talking about some other thing. So the stories continue, but the way in which they present the stories continue to vary, and that may appear convincing. Now they have made one more dip in the case of euro. 32.59 has become the low. I am just looking at the live market code page simultaneously and explaining you the live comments on that. Then the last 1.5 hours will be the late session, and this late session also they will be handling the majors. So the starting of the session and the ending of the session they handle the majors. During the mid sessions they handle the crosses. So we have to patiently wait during the mid sessions. If you are focusing or if you are only trading in euro or GBP, then wait for the start time and the close time and try to either enter and exit out of the positions. But during the mid sessions you can only watch if you are trading in majors. But if you are trading in the crosses, then they will make active moves, and probably you might come across the crosses breaching the low, breaching the high, etc. during that of the mid sessions. At that time the majors may not breach the high or the low, but they try to make the contrarian moves. That is euro showing positive net change, GBP showing negative net change, that sort of thing. They try to make it as a contrarian move and try to handle the cross. So this live market code page, I'm using it, which is a direct feed from that of the interbank treasury, and there you'll come across a dependable level, but it might be slightly delayed when compared to that of the trading platform for about 10 to 15 seconds. Then in the live market code page, make a note of the low high, which are all the columns you come across. First, after the bid and the ask, you come across low, and followed by that the high, and also you come across next to that is net. That is nothing but the net change from that of the previous day close. So yesterday's close level, euro has dropped now about 88 pips. So this is how we estimate how far the market has come down or how far the market has gone up. And I explained in my trading system webinars that they can rise or drop about 150 pips or 200 pips like that. And they try to handle the market in such a way that on a daily basis they either rise or drop 150 pips, up and down moves alternatively. That is why you find that market becomes unpredictable. But they have the weekly limitations also. So beyond the weekly limitation, they cannot continue to drop euro or GBP or continue to rise euro or GBP. So they have to make volatile moves in a market, and these volatile moves we have to identify and try to enter and exit out of the positions. after taking a buy position in euro, if you try to wait for euro to go to 1.42, in between there will be so many other factors. So in between the market might make a downward move, upward move, etc. You should not suddenly change your mind and say that no, it's better to do the swing trade. So there are different type of traders, and the traders need to suitably select the type of trades. That is, whether they want to be a swing trade on a daily basis or within the session, or a position intraday trader, just try to enter and exit within the day to avoid the overnight interest charged by the trading platform, or whether they wanted to be a position trader by taking during extreme moves in the market, on the downside take a buy, on the sell side take a sell, and try to wait to capture about 300 to 500 pips profit. So these things are to be decided beforehand, but you cannot aim for straight away the position trade. You have to necessarily enter into the market like any other swing trade. So identify the currency in which you come across the spread of 40 to 50 pips spread between the low and the high, and a currency which has done about 40 to 50 pips and above the spread. If you try to enter near that of the low, a buy position, near that of the high, a sell position, you will be able to easily capture some swing trade profit. Then the entry, normally when the session starts, wait for 30 minutes, and in this particular session, if the market is near that of the low, and try to take a buy, and if the market is near that of the high, try to take a sell in the 30 minutes time frame if it has not breached the high or the low. But today you come across that they have breached the low in the case of euro and GBP, the initial low what they have set. So let me show that particular slide. So in the case of euro, the initial low was 1.3304. This is the slide I use on a daily basis during Asian session live market analysis. You come across the previous day's lows and the previous day's highs of all the respective days, and these highs and the lows, initial lows and the highs, are set around 3:30 GMT. So today the low was 33.04, and from there they came down to 33.56, 32.56 now. So they continue to dip, and so they formed a new low from that of 1.3265 to 1.3256. So we have to wait till such time they stop cutting the low for 30 minutes. So we are not in a hurry to enter into the market. We don't go by that of the supports and the resistance estimated, because we want to enter actual market. So for this, observing the price behavior, we try to enter into that of the currencies. So the forecast, we use it as a guiding factor in order to identify where exactly we can make an entry and where exactly we can exit out of that. So the forecast says that today there is going to be a dip during that of the early European session, and followed by that a gain during that of the late European session. So it will give you the buy and sell trade opportunities even though the market looks very bearish. In the case of GBP, 1.5452 was the low. They breached it and they come to 1.5428. So just below that of the psychological level, 1.5450, they breached it, and the next psychological level is 1.5425 that they are not breached, and they have come to the level of 1.54. Now they are breaching it. 1.5424 has become the new low. So wait for at least 30 minutes from here and let them stop cutting the low. Then we will try to take. So I am just explaining all those things. When the right opportunity comes, I will take an entry in the market. Then in the case of CHF, 0.9192 is the low, 0.9269, 9226 was the initial high, and CHF has gone above that and formed a new high, 9269. So that means they have gone up above that of all these highs. So the downside move might be very limited. So let us see when they come to closer to that of the low, then we will try to take a buy position. And that will be a technical trade, buy above that of the high. Otherwise, a normal trade will be sell near that of the high and buy near that of the low. But once they breach the initial low on the high, we develop a different trading strategy, which might be called as a breakout trade by others. So we try to take a buy closer to that of the high or closer to that of the initial high and try to book profit during further rise. And in the case of yen, they are not breached the high or the low, 77.11 and 77.54. And in the case of Australian dollar, the initial low was 96.84. They just formed 96.67 as the low, just a nominal dip, but it will appear as if they have made a very big drop of 80 pips. But from that of the low, they are just nominally dropped to that of the next psychological level, 25 pips below. In some other cases, another 25 pips below that particular level. So now you find that 30 to 54 has become the low and 54.23 has become the low in the case of GBP. Euro and GBP, they are just actively handled, and Australian dollar, they are handled nominally, and once they come above that of the initial low in all these cases also, and is sustained there for more than 30 minutes, we can try to take a buy. And that's what you come across in the charts as a consolidation, and subsequently they come up to that of the initial low and they try to consolidate there, then they look for a breakout point, an upward move, and up to that of the high it will be indicated and people try to take the position. And for that, we don't require any sophisticated analysis. You can mainly or simply note down the initial low and the high, because I am simplifying this particular procedure so that you can easily monitor how exactly the players are handling it, because they use these initial lows and the highs as the prime level and try to see where their stops are and try to hit the stops below and go up and try to hit the stops above on a daily basis and session wise. So let me go back to that of the other PowerPoint presentation and continue the explanation. So now in the case of Euro and GBP, they have breached it. In case if they are not breached it near the low and not breached for 30 minutes from the start of the session, we can try to take a buy position near the low or a sell position near the high if the market is near that of the high. Then the exit will be the exact opposite level. So in the case of Euro, if you try to enter around that of 1.3303 or 1.3254 level, then the exit will be around that of 1.3352. So that we mentally prepare first of all. Then try to see that our buy position makes profit, and if once it makes about 15, 20, 25 pips profit, keep stop at entry and reduce the risk so that your hard-earned money is not lost in the process of trading. So in the process of trading, in the effort to make money, if you lose, that means your effort goes waste. So ultimately, you have to fine-tune your understanding of the market, and the players are here to make up and down moves in the market alternatively, and they are not going to make any currency as a waste paper, and definitely they are all supported by that of their respective governments. In the stock market, at least, if they don't get the coordination or cooperation from that of their respective company promoters, then probably they can make it as a penny stock. But in the case of currencies, it is not possible. So you have to understand that and fearlessly try to trade. For that, if you want to get rid of the fear, the first and most important thing is take very less position at a given time and try to prepare yourself with the knowledge of the type of trades you can choose depending upon the market moves. Then obviously, when the market goes against, you will be able to have the strategies in hand to implement rather than you become stunned and try to do crisis management. So that you have to avoid. And many of the people have got the tendency when they quickly drop and they see that usable margin gets eroded, immediately they cut the position. And that becomes an impulsive decision. Later on they realize that the market, he was the only person sold at the lowest level. Later on the market has started going up. So you should not face that particular situation and again. That means you are not prepared yourself for trading. Without understanding the process of trading. Trading is an art and we need to understand it only then you will be able to successfully handle it. Then impulsive decisions during trading is detrimental. In the event, if they breach the low or the high, you have to identify what is the type of move they are trying to do it. No, I explained the type of moves the players do it in the market. They do it in a very sequential way. They make an upward stop and then try to go down. Upward stop is they try to go above that of the initial high for less than 30 minutes and come below that of the initial high in that 30 minutes time frame and start making a drop. And then they come up to that of the initial high and start making a drop further down. So they make a stop and on the upside, then make a false move. That is, after a drop, they come up to that of the initial high. Then afterwards, continue downward very quickly and breach the low like what they have done it now and make an extended move. And they breach the low and go below for about 30-40 pips. And doesn't matter, they can do that stop and on the downside. But we need to watch whether it is a downward stop and or whether it is an extended move. Downward stop and they cut the low and stay below that low for 30 minutes and come above that of the initial low in less than 30 minutes. Now, in the case of Euro, for example, 1.3303 was the initial low, and they breached and came down to that of 3254, and they are still staying below that of the initial low. So we have to wait for 2 hours in order to take the position if you want to be a very safe trader. Otherwise, if they stop cutting the low, the new low for 30 minutes, then you can also take a buy position and try to keep stop at entry once the position makes profit. So hope you are able to understand. In the extended move, they try to make a downward move and they are supposed to cut the new low in every 30 minutes. Then if they just make a drop and stop cutting the low for 30 minutes, that means they are not going to cut it. They simply hold it for 2 hours and start gaining the level. They test the patience of the traders by holding near that as a new low, and obviously people think that Euro doesn't have a strength to go up as if it is a living organism which has got a strength and weaknesses. Somebody has to move it and somebody has to drop it, and they immediately say that Euro looks very weak. It is not having any strength to go up. Then once you talk like that to yourself, you become emotional without understanding that inanimate thing. You are simply imagining that it is something making the move on its own. It is something like a small kid trying to keep a teddy bear and say that the teddy bear, come on, come along with me. If the child talks to a teddy bear, we know that it is a child behavior because the child does not know that inanimate things cannot respond to your questions or your commands, and only a living organism can do that. So the child, out of love and affection or out of that mental maturity, try to do that. And if you simply say, come on, Euro, go up, like a horse race, and it is not going to go up just like that, that means you are impulsive. And the market is here to punish the impulsive people. And if you are very smart and calm-minded, you will be able to understand the type of moves they are trying to do it and easily make money and laugh at the players that you cannot cheat me. Then intentional move is the one they continue to drop or rise for more than 2 hours. So if they cut the low and again in another 30 minutes cut the low, another 30 minutes cut the low, then continue to cut the lows formed for 2 sessions, then it is intentional move. In case if you find that after 2 hours, if they are just continue to cut the low, the first 30 minutes they don't cut the low, that means they are going to reverse it. If they cut the low in first 30 minutes of observation, then they could make an extended move of cutting the new low for 3 times. Then last time they will stop cutting the low. The last 30 minutes they will stop cutting the low, then start gaining the levels. So then you understand it is an extended move. In case if they cut the new low again in after 2 hours, that means they wanted to continue the drop for 2 sessions. So suppose you are observing the European session, they could extend it up to that of the US session. So there is no question of forecast or any other analysis required. Straight away you can understand that they wanted to make an intentional move of a downward move. In case if you have got a buy position, you simply hedge it, take another sell position and try to book profit towards the third session. So suppose they started making the drop, cutting the new low during European session and also during that of the US session, then they will make one more downward move during the next session, that is the next Japanese session, and then start gaining the level quickly during that particular session. So simply take a sell and close it during the next session and try to take another buy and try to book profit during that of the rise. If you read the intentions very clearly, you can continue to trade without any fear, without bothering about whether euro is in crisis or US is in crisis, etc. You can try to book profit in that of the next buy position, and when they come to that of the hedging order, you simply close it with stop at entry or book profit during the next drop, then continue with that of the buy position and continue on the up. When they move on the upside, try to book profit on the buy side. So if you try to use the hedging effectively, you can simply continue to trade without any market fear. If you are impulsive, you do not know how to read the type of moves in the market, there comes the biggest problem in understanding the market. The forecast is a forecast, which is we are trying to estimate it using various parameters and try to understand which way the market could go based on the fundamentals, based on the technicals or whatever it is. But the actual reading of the market, the price action and the type of moves, if you follow it, you will be certainly doing the trade along with it of the players without any fear. Now, so this is what I was telling you, how exactly you can use the hedging and try to use it effectively for either way trading. Now you find that euro, they started gaining, accumulating the positions, and we observed it around 9 GMT, the downward move, and almost it is come closer to that of 9:30. They are not cut the low. So let us straight away demonstrate it. And in this session, euro and GBP are expected to slide and firm up. This is the forecast. So I'll explain about the hedging after taking the positions now. I'm just taking a buy 1.3265. You can try it in a demo trading platform. Don't try it in a real trading platform. First of all, you have to understand the concept. You cannot simply imitate. And then once you are able to digest the situations or the concepts, then you can try it in a real trading account. So I'm taking a buy 1.3265 with an entry stop of 30 pips. Entry stop is otherwise a hedging order. And if you are taking a buy at 1.3265, there are platforms in Europe and other places. They are offering the hedging, excepting the US trading platform. There, so 1.3235 will keep a sell limit order, that is hedging. And the buy, straight away we are taking a buy position. Because 30 minutes is over, so that is why I just jumped into it. They are not cut the new low. And if you are smart enough, in 10 minutes itself you can take the buy position. You may not be able to fine tune and exactly buy it at 30 to 54 and 30 to 56, 30 to 59 also fine enough. And if you find that they are not cutting the new low, and if they cut the new low and come above that of the earlier low in a fraction of a second, then understand that they tried the last downward stop and then started gaining the levels. So now they have started gaining the levels. Where is the question of bullishness and bearishness involved in this? And if you become bullish and bearish, then you will find it extremely difficult to understand. You will expect the market to go above that of 1.34 and try to take a position, and they go just about 10-15 pips and start making that drop because they know lot of traders come for breakout trades. So you try to choose any type of trading, either a breakout trading or a swing trade or whatever it is. If predominant of the traders try to do that particular type of trade, the players try to trap them because they wanted to earn bulk of money. So you try to identify a trade which can go along with them, and definitely it will give profit for us. So in the case of GBP, it is currently trading around 1.5455, 1.5423 was the low. So we will try to keep a buy limit order. Just 10 pips below that of the market, so that we fine tune our entry, and market means swings, they will make up and down moves. In that process, we can try to get our buy order get filled, and if it is not filling, then probably you can modify and try to take it at a better level. Entry stop of 30 pips. So as soon as we keep an order, we try to keep hedging order, so that we define our risk only for 30 pips. And once a position makes profit, we keep stop at the entry and remove the hedging order. So what you come across at the advantage of hedging. So we use hedging instead of stop. Once a position makes profit, keep stop at entry. So we simply use hedging to limit the risk, and if they hedge it, it's a different scenario. I'll explain how to handle it. And in case if they don't hedge it, then you are able to keep stop at entry when the position is making 20-30 pips profit. Then the hedging you are using instead of stop. When you use stop, and they could hit the stop because they are stop hunters, so they hit the stop and go up. And in that scenario, you lose the position later on, become fearful of entering into the market. And by the time you reconcile and think that, okay, it was only a stop and so I can enter, then the market would have gone up. So if you have the hedging, you can review the hedged position, whether it is making loss or a profit for about 30 minutes. If it is not making profit, you just close it with about 2-3 pips or 5 pips loss and keep another hedging order quickly, so that you don't take unlimited risk. Just about 10-15 pips below, you keep another hedging order, limit the risk. And once the market starts moving up, move the hedge to that of the original level, so that again you keep only 30 pip risk. Until such time you keep stop at entry, the hedging will be working for you. So hedging is used to continue to trade when the market moves in our favor. So you simply use the hedging. For example, in the trade, I'll explain. Suppose I got a buy position at 1.3265 and the hedging is 1.3235. You simply hedge it and gone to 1.31. Doesn't matter. I am not bothered. I have only blocked about 30 pips in that process. And once they start going it, and this is making profit, I keep stop at entry here. Let them go anywhere they want to, 1.28 also, doesn't matter. And let them come up and close my stop at entry. Then I'll continue with my buy position. It's a matter of about 1 or 2 sessions or 1 or 2 days maximum. Then you should be able to see that you are able to book profit either way. So hedging can also be used to continue trading when the market moves only in our favor. When it moves against, simply we keep hedging and limit the risk. And for that, you need to know how to handle the hedging. Because you do not know how to handle the hedging, if you simply say that hedging is a wasteful exercise, that means you do not know about the concept, the scientific concept, and if you simply say that it is nonsense, that means it shows your ignorance. Many of the people think that hedging is nothing but a nonsense. Then hedging can be used to do either way trade. Let me explain it. Okay. suppose my position is hedged, 32.35 is hedged. Then the market comes down to 32.05 and stopping the low in the next session for 30 minutes to 2 hours. Fine. I just close it with a profit here, about 30-40 pips profit, and keep another hedging order below that 30 pips. So at any given time, I'm taking risk for 30 pips. And why I'm keeping a hedging order? Because this hedging I have booked profit, and this buy position, the risk has to be limited on the downside. So I keep a hedging order 31.85, and they start gaining the levels. I trail the hedging order upward until such time I am able to keep stop at entry here. In case if they hedge me again, I watch for 30 minutes, and if they are not showing profit, I cut the hedging and keep another hedging order just about 10-15 pips below and trail it up as they gain, because the players are also like trying to look for trailing stops, trailing hedging orders, etc. in the market, because as soon as any new facility is added to the platform, the players also try to make moves in such a way so that they can trigger all the stops. And so when the trailing stop hedging order comes, if they hit it, watch for 30 minutes. If it is not making profit, you just close it and keep another hedging order 10 to 15 pips below. If it is making profit, keep stop at entry. Let them go down again, doesn't matter. Then try to book profit on the downside. And once they stop cutting the low for 30 minutes to 2 hours, they keep another hedging order below and trail it up. So you might be holding a buy position. You'll continue to earn in the sell position when doing downward move. And then once this, because you know very well, they have to necessarily make the up and down moves alternatively in order to trap the long holders as well as the short sellers in the market. When they start moving upward, trapping the short sellers, you will happily find the profit in your buy. You can book profit. That is one of the type of trading strategy. Sorry, I thought that I can explain the hedging one by one, because many of the traders have got still doubt. They are not able to understand. That is why I'm just going to that of the practical example and trying to explain these concepts. So either way trades, on the downside with the hedging, on the upside with the original position. Then hedging can be used to reverse the trade when the other way going is good. If you find that the hedging is continuously making profit for 2 hours. Okay. 30 to 35 is filled and the market started moving down and it is continuously making profit for 2 hours. Then you understand they are trying to do the intentional move on the downside. It is not an extended move to book profit and again try to book profit at the buy side. So they are doing intentional move. What do? You just hold the sell position. You cut the buy position with 70 or 80 pips loss. Doesn't matter. 50 pips profit is already blocked in your sell side. You know that when they make an extended downward move, they make about 150 pips down move. So you are already blocked 50 pips and only 30 pips you are lost when you cut the buy with the 80 pips loss. So it is actually 30 pips loss only. It is something like stopping out one trade. Then on the sell side, you are having already 50 pips profit. And if the market moves further downward 30 pips, then you are at break-even. Then further downward during the day, during the session, on the third session, then once they stop cutting the low for the third session, you try to close it with 200 pips profit. So 80 pips loss, 200 pips profit, 120 pips net profit. So you can take a decision provided you identify the type of moves, whether it is an extended move or an intentional move. Then it is easy for you to determine. Then hedging is used to hold the position and continue to trade when time permits. In the event of emergency, we can simply hedge and leave the trade. So suppose you taken a position, there is an urgent call from your office or some hospitalization and things like that. Immediately you can hedge the position instead of closing the position. I can continue to attend to the other work, come back and see which one is making profit. Like the other one, the trade I explained, suppose the buy is making profit, the hedging is making loss. You find that they are making an intentional rise. You simply close the hedging with the 80 pips loss and 50 pips blocked in 50 pips profit is seen in the buy side, and if they rise another 30 pips, you'll have a break even. Then when they continue to rise, fine. So just because in the hedging you are cutting about 120 pips loss or 80 pips loss, it doesn't mean actually you are incurring 150 pips loss. And the buy side is protecting 30 pips lesser than that, the profit. So if you understand this mathematics, then it will not take away in a hedging platform all the 150 pips. It will only take away the 30 pips from your equity. If you check it up, you will be able to understand. Then hedging can be used to close the position any time frame instead of stopping out the position during uncertainties. Suppose you are going for a Thanksgiving holiday, you simply hedge the position and go for that, and later on come and see whether the market is moving down or an up and continue the trading. So in the event of uncertainty, we are not able to really determine whether the market is making an upward move or a downward move because it is continuously making sideways move. You simply get and watch the market, and later on you can continue the trading. Then hedging can be used to spread the risk with a limited risk in each position. I explained many times this. The position trade, every 100 pips drop in a currency, try to take a buy position. Suppose you are in a position capability of taking one standard lot position, then spread the risk. Instead of taking one standard lot, one mini lot at a given time, take a buy position. Suppose 1.34, we are taking a buy. Then when they drop to 1.33, take another one mini lot buy, 1/10 of a position. Then 1.32 doesn't matter, another one mini lot. And beyond that, they are not going, and the last one is making profit, you are able to keep stop at entry and the market going up. Then take the rest of the lots and try to grab all the profit. So that way you can spread the risk. Here, there again you can use the hedging. So you test the market by yourself by taking a position, by taking a very mini lot. This you can do it if your equity is sizable enough so that you can spread the risk. Hedging can be used for breakout trades. Suppose they breach the high and stay above their high for more than 30 minutes. You try to take a buy position there. Try to keep a hedging order below that of the initial high as a breakout trade. Suppose you want to do a sell and buy trade in the case of euro. You just take a sell below that of the low and try to keep a hedging order buy above that of the initial low so that it can be used. In the event suddenly they reverse it, you will be hedged. You will not be caught at the wrong side on the lowest level. Then you can handle it by, as I explained here, whether the hedging is making profit or the original position is making profit, and accordingly cut any one position and go along with the stream of the market and try to book maximum profit on that particular side. Then hedging can be used without additional margin in many platforms. Suppose the platform is taking about $500 margin for a standard lot. Then if you take the hedging or $1,000, and if you take hedging, it does not take additional margin. Whereas if you take the hedging in some other pair, it takes additional margin from your equity. There will be a burden on the equity. So that can be avoided if you have the facility of hedging in the same pair. Hope you are able to understand how exactly the hedging can be used effectively. I thought that I should explain it. Many people ask this question during the Asian Session Live Market Analysis webinar. That is why I just taken it. So I am just limiting myself with these two positions. Now already euro has come to 32. Now GBP has come down, so it's already gone up to 54.71. So I am not trying to take only one position. I had taken it in the case of euro. So if I would have developed a bearish field and waited for the market to drop, then I would not have entered in. And I know very well wherever I enter, whether I buy euro at 1.48 or 1.32, I am just limiting the risk only to 30 pips. So I will not give importance to the level. I will only try to find what sort of moves they are trying to do it and whether we have to do a buy and sell trade or a sell and buy trade. So here they had done a downward stop in order to make an upward move. So that is why I chosen to take the buy position, even though market appears bearish. So let me minimize the PowerPoint presentation and take up the questions which are asked here. Already time is up. Let me try to answer some of the questions if possible. Then Chris. You noticed on live market quote page that the bid and the ask are the same. I noted that, yeah, sometimes it happens. That means they have placed such orders to trigger the market. They keep the buy as well as the sell. What happens? That particular sell will trigger all the stops and the buy will be there to absorb all the stops. This is the mechanism they do it. And unfortunately it was displayed here. It was not supposed to display. Now again it will come across. They are handling it that way. They place the buy order and a sell order. Then gradually it is. So all the tricks are being revealed. That's what. They are the seller, they are the buyer. And they hit the stops and buy. It is being revealed very clearly now. There is no question of bearishness and somebody is selling, somebody is buying. Then I was wondering, you marked more predictions in terms of the currency pairs are almost perfect. But I noticed recently S&P 500 has not followed. Okay. Yeah. Again, no, in the case of S&P and Dow Jones, they made the correction in order to gain the levels during the last peak of the month. Again, from today, you'll find, and another 3 days in this particular month, you will find that S&P 500 started gaining the levels. And December also, with a brief sideways move, they are expected to gain the levels in the case of stock market. 10. Problem in using the hedging is when you return, it is decided which side to close, otherwise no gain. Yeah, you have to understand that. That can be easily understood. You need not check with me or check with anybody. You can identify the type of move they are doing at the time of looking at the market. Suppose I had taken a position today. I was not in a position to continue because I was busy with some other work and things like that. By the time I come back, the market got closed. Doesn't matter. My position is hedged. Then Monday I come back and see which direction the market is moving. So I'll observe it for 30 minutes. In that, whether the hedging is making profit or my original buy position is making profit, I'll observe it. And whether the market is near that of the high or near that of the low. Are they making an extended move or an intentional move? Then if they are making an intentional move, I'll simply close my sell and continue with that of the intentional move on the upside, try to maximize the profit on the buy side. If it is an intentional move on the downside, I'll simply close my buy with a loss, continue with the sell, and the difference is only 30 pips. By the time, once I cut the buy, then the sell will be making another 30 pips profit. I'll be at break even. I can use a trailing stop to protect that particular profit. Then, when the market continue to move on another one session, I'll be in net profit. So, identifying the type of move is very important. There are two types of moves which are very important, extended move and the intentional move. The another factor to identify them, besides the duration it takes, the quickness, the momentum of that particular move. Whether it is a very quick upward move or a very quick downward move. You know, they made a very quick downward move in the case of Euro from 1.3303 to 1.3254. Quick moves or fast moves in the market. So if it is a quick move, it is an extended move, that's all. Then afterwards they start accumulating the positions. If it is a slow dip, pip by pip, pip by pip, then it is an intentional move. You can identify they are not, any level you buy, they are not giving profit. Then cut the buy and continue to maximize the profit on the sell. So you have two differences, one with regard to the time frame, another one with regard to the momentum. Will it be difficult to identify? If you keep your mind calm without any distraction, you'll be able to easily identify it with the help of a live market code page. Morley. Will they revisit today's low in Euro and GBP again? They had done it as an extended move. Let us see how exactly they wanted to do it. And if they go during the rise, if somebody buys after the rise, then they may have to dip and hit their stops. During the rise, if the traders sell, then they continue to rise and trap them on the upside. So you find the herd of traders, how exactly they are taking positions. By their moves, they can easily identify what the traders are doing world over. Then, how many dollar need to take one mini order is safe side? No, normally in a mini lots, they take about $50 to $100 as a usable margin. Do you think that we have the low? Everybody is asking the same question. See, let me tell you very honestly, nobody will be in the world to identify, okay, this is the low is in, and things like that. And if you try to take a buy and keep the stop, and the players find cluster of stops below that of 30 to 54, definitely they will be tempted to hit the stops and go up. Sorry. Because many of the people have got the tendency to ask whether the low is in, whether they will revisit the low, or they are not going to drop further down. Then they wanted to buy it at a higher level. That is why they ask that question. But always when they make a dip, you try to buy it. During the rise, don't buy it. So in the case of GBP, I kept about 47. They are not filled it. I'm not jumping to the market. Let them make a small dip, then I will try to take a buy. Because it's a mid-session, during the late session, they will try to show some active moves. And also you come across in the case of Euro, 79 pips negative net change. And in the case of GBP, only 19 pips negative net change. That I was explaining yesterday's Asian session webinar. Then they took it up to the 86.77 in the case of Euro GBP and started dropping it. So now when they want to drop Euro GBP, they have to make less drop in the case of GBP and more drop in the case of Euro. They are handling all the currencies respectively. So when you trade Euro and GBP, where is the question of bearishness and bullishness involved with regard to those two European country and the UK? So they try to make moves with a purpose. And we think that Euro has dropped it just because of European economy. So European economy has weakened for 50 pips. Can anybody measure it that way? Then Joe D. Is this downward move of the stocks a stop end? And no, actually for the Thanksgiving Day holiday, before that they made the drop in the case of stock market. For those who are holding long positions, to square up the positions before going for the holiday, later on they are expected to give another talk. It is a year-end move. Okay, what is the level you expect Euro to go by year-end? Everybody will start asking this question, and you'll come across one will say that 1.24 and another will say 1.42, and we all will be watching it. The market is expected to go to higher levels. So that is how they try to change the market sentiments from time to time. When everybody is thinking about Thanksgiving holiday drop, and they will say it is a year-end move. And when you follow the year-end move and try to take a buy position, then they will say US economy is weak, so they drop it. So on a daily basis, they give different stories for us to believe. We honestly believe those stories. Then Jason. If it is a real situation, then the situation has to be explained in detail and the market has to follow it. When the market is not following it, they are all nothing but hypes. Then Jason. Aussie and GBP are above initial low, so we can know that it is going up at least initial high. Yeah, they are expected to go up. Now Aussie, they recovered it very fast. I told you that they are above that of the initial low, then they are expected to go up to that of the initial high. Once they break out, you know that the commodity pairs are the leaders. They lead the rally and lag behind. So now you find quick rise happening here. So once you identify what the drop meant for you, it is only just to deceive the traders, nothing more than that. We're able to practically see how exactly they are doing it. Then asked him, is stop and always followed by false move? No, first of all stop and followed by false move. Then extended move, and it can be turned out into an intentional move, otherwise again a false move and a stop on the other side. Euro is still set for gains, yes. And they are buying it at a lower level. Holding low, they try to buy. If the traders are not willing to turn sellers, they drop further down. And everybody will think that I could have done a sell and buy trade and made a huge profit. Okay, at least this time let me take a sell. Then he happens to be the last level sell. That is the saying in the market, when the strongest bull turn bearish and start selling in the market reverses. Then did you miss your comments on the expected move of Euro and GBP for the rest of the day? I explained that initial dip and the rise during that of the European session, and US session swing and quick rise are expected. Okay, no more questions, Lo. Let me go back to that of the PowerPoint presentation. So only Euro I have taken a position, and GBP I kept a buy order that is not filled. I'll watch till that of the second part of the webinar and see how exactly I can book profit in this. And once it goes to 32.85, 32.90, I'll keep stop at entry and remove the hedging order so that no risk. Then afterwards, when they start gaining it, I'll convert the stop into a trailing stop and trail it upward. Keep a limit 33.52. That is the high. The going is good. I'll move away the limit above, but not the trailing stop. This is the trading strategy to be followed, and that's what I am following. So I just explained my methodology. So I'll come back again by 14 GMT, and there is going to be the gap time before the start of the US session. 14:30, the US session starts, I explained. So gap time moves are false move. Let us see how exactly during the gap time we can take positions, and I also explained to you the methodology of how to enter and exit in that of the market in my understanding of the forex market. Then see that ultimately whatever be the method you follow, if you are able to consistently make money from that of the market, then develop it as your system and use it without any distraction. You will be able to really become a successful trader. Fine tune it, you will become a successful trader. So I take this opportunity to thank FX Street and also you people who have come here to listen to my webinar. And I request you to come back during the second part of the webinar by 14 GMT. We will continue our interactions during that time frame. Thank you one and all. See you again.